Hey, how's it going? Welcome. We just got the closing bell for November 6th, and it was a pretty exciting day. We got the election results. Some volume came into the markets. We definitely got some direction, and that's really what we were looking for the past few weeks, maybe even over a month now. The market had really just been going sideways, and now with the election results kind of behind us, we are free to get directional in the markets again. But we have some things in the way first. So we're not 100% free and clear yet. And we'll just have to see how other things play out. For example, the FOMC rate cut decision tomorrow. So let's take a look at absolutely everything. We'll get a really broad market top-down view and then decide what types of actions might be appropriate at this time for the markets. Let's start with the SPY, and we'll go intraday and take a look at what happened. Eesh, that's kind of messy. Let's get rid of some of this. Okay. So today you can see that this is the wrong stock, SPY. We gapped up. There was a profit taking early in the morning, and then we came back up, back above that VWAP, and we were very bullish throughout the rest of the day. Now, what tends to happen, because there's pent up demand, there's pent up money that needs to be allocated. There's been a lot of money managers, fund managers that have been unable or unwilling to allocate their capital during this time period before the election results were known. So now they need to get their money to work. They only have a month or two left before the end of the year, and they've been stagnant. If they don't start putting their money to work, what happens is the S&P has just started to move. And if they don't move also, then they're going to their performance is going to deviate from the S&P 500 too much. Some managers are at things like discretionary funds, hedge funds. They get to choose exactly what they want to invest in at any point in time. That means they're not necessarily beholden to a certain set of rules or guidelines or a particular benchmark. In those cases, the tendency is to benchmark to the S&P 500 and to beat it as much as possible. Other fund managers, they are benchmarked to other things. Sometimes it's, oh, I want the S&P 500 plus 2%. Well, if I go and I beat the S&P 500 by 10%, I'm in trouble. I didn't actually do my job. If I'm benchmarked to something else like treasuries plus 1%, then I can't go and try to match the S&P 500. I have to benchmark myself to the treasuries. So it's inaccurate to say that all fund managers are indexing themselves to the S&P 500 and just trying to beat the S&P 500. There's a lot of fund managers that will manage private money, for example, or they'll receive cash. For example, what I did back at PIMCO, a lot of times the cash came from places like retirement funds, the excess cash that, for example, Apple or Google or Disney was carrying. And they needed access to their cash. They weren't looking for super high returns. They weren't looking to beat the S&P 500. They just wanted their money to be safe and available, and then maybe make a small return on top of that. So there's no point in indexing to the S&P 500 in those cases. But the ones that have discretionary use or discretionary power over the investment of their funds, they will tend to, not always, but they will tend to index themselves to S&P 500. For example, Cathie Wood, the ARK fund, she's not indexing herself to the S&P 500. She might be indexing herself to the Russell 2000. So don't go and buy all this stuff about people say, hey, these fund managers, they just want to beat the S&P 500 and 90% of them can't do it. No, 90% of them aren't trying to do it. They're only the ones who have discretionary funds or funds that are specifically attached to the S&P 500 are trying to beat the S&P 500. But for those people, right now, what has happened is suddenly the uncertainty in the markets, or a lot of the uncertainty in the markets, has been taken away, and we see the S&P 500 move. That means their portfolios have to move also. They can't sit on the sidelines anymore. They need to start putting their capital to work so that they can keep up with the performance of the S&P 500 or better. So we are going to see capital start to move in. We've got a decent amount of volume in today, 54 million versus the 46.8 average that we've been seeing. There hasn't been that much activity above that average line for quite some time. So we should start to see volume come back into the markets. And now that we've made a move and we're starting to get volume back into the markets, the tendency after an election is to keep that momentum. So before this, I drew this box. And actually before this box, I drew another box that isn't here before, but it was kind of over here. Okay, so you can see these two boxes. They're basically, it could become just one giant box like this. And basically, since the previous FOMC rate cut announcement, we've just been contained within this box. And for several weeks, I said it would be difficult for us to get above 585. And then we kind of got to this 585 level. And now today we broke above the 585 level. And we weren't sure if we were going to break down or if we were going to break up. For a long time, I was talking about how there's greater risk to the downside than the upside. And we actually did go to the downside, but that was contained by the MA50, which moved upwards. So that downside actually didn't end up being too bad, but we did have a pullback to that MA50 and now a nice hard gap up bounce up above 590. 590 was a resistance level within the gamma options market for a very long time, as was 585. Now that we've kind of breached both of those levels, that does clear the way. And if you go a few weeks back, I was talking about how after the election, we do have the potential to reach 600 or higher. Now we're all the way at 591, so 600 doesn't seem that far away, but we do have the potential to get to 600, maybe a little bit higher to the end, into the end of the year. So we do expect that this upward movement and momentum is probably going to carry at least for a couple of weeks, if not into the rest of the year. So what does that mean? Does that mean that we jump for joy and we jump in with all our money and start buying everything? No, of course not. This is a huge gap up. That's a big gap up, and those gaps tend to get filled because it's too much too fast. This is a little over enthusiastic. What we expect to see is what we saw earlier this morning, which was profit taking. Huge gap up, profit taking. Now, I also made a reference. Did I? Oh, maybe I didn't publicly make a reference. Well, I'll publicly make a reference now to FXI. Remember what happened in China. Huge gap up, pause for a day, huge gap up, pause for a couple days, huge gap up. But then what happened? It came down. It pulled back, and then it started to consolidate. So that's the type of behaviors that markets exhibit when there's a change, there's enthusiasm, there's a shift. And all shifts and all changes in the market come with opportunity. That's actually probably true of all of life, but very, very much so in the markets. If there is a change, if there's a shift, then you have opportunity. And as long as we were chopping sideways, that was not a change. Now we have a change. That's opportunity. What's probably going to happen, most likely going to happen, is that we do see that profit taken occur, and we do see something similar as what we saw in China, where we have this gap up and then we have a pullback. Does that mean we pull back right away? No, we saw in China where it gapped up a couple of times, but I don't think we have that kind of stimulus inside the S&P 500 right now. One gap up, maybe a trade sideways and a little bit higher, but we are going to expect in the next week or so that this would pull back to a more reasonable level. For example, an EMA 8 or EMA 20, Or what could happen also is we could consolidate here for a while. And this has now become this 580 to 585 area has become a strong area of liquidity or support. So that we could pull back just to there, maybe not all the way down to where the EMA 8 and 20 are currently, the 570s levels. We might just pause at this 585 level and allow these moving averages to come up and meet the market price level, and then we'd be open to moving higher from there. So it could take form in a couple of different ways. The other thing that we want to make sure, though, is that there's still enough momentum left in this market to carry itself upwards. If there isn't, if we kind of shot our load right here, then we don't have any more fuel to keep on going higher. And that's why we would need a consolidation or pullback to enable us to move higher. So in just a moment, we are going to check out those momentum levels. But before we do that, I'm going to take a quick look at bonds. Bonds gap down. So that makes sense. There's money leaving certain assets in order to go into the stock market because people are excited about that. Will this revert? Yeah, most likely it will revert at least some, but this continued that downward movement in the TLT, which means that interest rates, long-term interest rates are going up and they are higher. And this is putting the Fed in a very difficult position because they chose to start lowering rates. They chose to say, hey, I think we've done enough for inflation here. We don't need to fight inflation anymore. And the market said, I don't think so. I think you did that way too early. And therefore, we're going to raise rates on the long end. And that's in anticipation of inflation rearing its head again. So we'll see. We'll see what the Fed does tomorrow. Most likely, the market is pricing in that most likely they're just going to cut by 25 basis points. Let me refresh that. Yeah, 25 basis points, very small percentage chance of a 50 basis point rate cut. And so we'll see, because any sort of cutting is still inflationary. So we'll see if how the bond market reacts to that. It should be priced in already with 98+% probability that they're going to cut by 25 basis points. But we'll see what the actual reaction is tomorrow. This is another reason to wait and see, not get too enthusiastic about this big gap up in the markets, because we have the rate cut decision tomorrow. So what we want to do now is see which sectors got the money today, which sectors lost money today. So we know that TLT, we know bonds lost money. They're probably going into the stock market. But what about other commodities? What about precious metals? What about oil? What about other sectors? Which specific sectors received money? That's going to be very telling, because there's a thought process before all of this happened was that, hey, if President Trump wins, or if Trump wins the presidency, then that would be really good for traditional energy, and it would be good for maybe American industrials, things like this. Whereas if Harris won, then green energy technology would benefit more. So we'll see how that played out, just to see where money is actually moving at the moment. And again, we'll take a look at those momentum levels. Maybe I'll look at the momentum levels first really fast. We'll just get a quick glancing overview of the momentum. So overall market momentum, we do have 66% above their moving average. This is stocks above $2 that have been in the market for at least 6 months. And then we've got 63% above the MA200. That's pretty healthy. Let's take a look at particular sectors and particular indices. Russell 6672, that's fine. Dow is in a little bit of a danger zone with a 50% above its moving average, 200. So let's see what happened with the Dow today. Dow did gap up quite a bit, though. So for it to gap up and still only have 50% of stocks above the MA50, that's not a great sign, because what did I say? These huge gap ups are most likely going to be met by a pullback or a consolidation sideways, which means that we're not going to see a lot more stocks coming above that 50 moving average. So this is a little bit of a tenuous situation for Dow Jones. Not like bearish situation, just not super optimistic for the move upwards. Let's take a look at NASDAQ. Did we see NASDAQ? NASDAQ 6566, that's not bad. Look at our sectors here. Our consumer staples are doing very poorly, 32%, 37%. Our consumer staples, according to this, it's in a bear market. Consumer staples are not doing well. So money coming out of consumer staples, that would make sense because now it's kind of a risk on attitude. Now that we have certainty and clarity in the markets, money should be coming out of the more conservative sectors. For example, we saw it come out of bonds. Well, it should be coming out of consumer staples as well and going into riskier assets. Let's take a look at real estate. This is completely interest rate, and you can see that this 26% is a huge deviation from this 74%. This is purely an interest rate play, and also reflecting the long bonds and the short rates that the FOMC controls. So this is going to be interesting because there will have to be a resolution. It can't stay this extreme for too long. So either this is going to start come tumbling down towards this 26%, or this is going to move up towards that 74%. And realistically, we see usually about a 10 to 20% difference. So if we look at industrials, that's a 13% difference. That's very normal. IT being equal is not as normal, so that actually would be a sign of potential weakness or topping right here in tech. And over here, 50 versus 68, that's a more normal relationship, but again, this one is on the brink. And then we've got, say, this overall S&P is a more normal relationship, 60 versus 74%. So real estate has this extreme, so we need some sort of resolution over there. And I'm going to look at a chart in a moment, but based on what's going on in the interest rate markets, it does seem like that this is more likely to move down towards the 50-day moving average percentage number. Of course, they could both be in between. They could both move, but even so, are they going to meet at a point where both of them are above 50%? Probably not. So it is looking kind of bearish for real estate as well, and utilities not looking so hot. So we've got and healthcare not looking great. We've got a number of sectors that are not looking super strong, which is interesting because in a true bull market, all sectors are strong. And we don't have that. We did have that earlier this year. All markets or all sectors were strong. Now we've got a very clear divide between certain sectors and others, for the lower risk sectors and the interest rate sensitive sectors for sure are underperforming the rest. So we are getting a little over enthusiastic in terms of growth. Money is piling in. So that's something that I want to be very careful of when I look at allocations to different sectors and how much of my portfolio is exposed to each sector. So let's see if there's anything else over here that I can see real quick. And then let's take a look at our sector scan over here. Or actually, we're looking at momentum. Let me look at 90-day highs and 90-day lows. We're 600 stocks making 90-day highs. So all those stocks that gapped up with the S&P 500, 600. So this includes ETFs. So that's why there's more than 500 over here. Includes ETFs and mid cap and small cap stocks. So it's not just S&P 500 stocks. That's really extreme. Anything over 400, we usually see an immediate pullback the next 1 to 2 days. So that's what this is indicating. The S&P 500 gapped up, and earlier I was saying, hey, we might consolidate sideways or we might pull backwards. Well, based on that momentum indicator alone, it seems more likely that we're going to pull back. So that means we don't want to jump in. So yes, we are becoming more bullish. Yes, it does look like we're bullish for the rest of the year, but we have some warning signs here in our momentum, in the division of performance in the different sectors. And now we have very short-term indicators of momentum telling us, hey, yeah, even though that you have this bullish view, maybe wait a couple of days because you'll be able to get in at a better price. When this pulls back down again to the EMA 8 or EMA 20, that might be a much better time to enter, and then you could start to take advantage of that potential bull run for the rest of the year. So I wouldn't be buying any new, or I wouldn't be opening any new long positions in the market until I saw this pullback. That could be, this is general market, general stuff, not specific. So we would look into specific sectors to get more specific, and then specific stocks to get more specific. But in a general sense, you want to be trading with the market. So if my expectation is a pullback, then I'm going to wait for those pullbacks and then start looking for opportunities to enter the market. You might be like, Kane, what if we just looked for a counter trend move and just short the S&P for a couple of days and then buy back into S&P? You can do that, but that's not a high probability setup. You're not going to have a large edge when you do that because you're going against the overall markets when you do that. So, or the overall trend in the markets. So when I look at this, I ask myself, are buyers in control or sellers? Right? Are buyers in control or sellers? And even if I look on an intraday basis, are buyers in control or sellers? Buyers are in control. So I don't want to be going and selling when buyers are in control, and I'll just get wiped out. So if I do choose to look for some sort of short in order to take advantage of this potential pullback over the next couple of days, I'm going to look at the very weakest stocks in the market, not just any old, hey, it gapped up. It might fill the gap, so I'm going to short it. No. You want to look for the weakest stocks and say, hey, the S&P gapped up 2.5% today. This one went down. Look how weak it is. So when the S&P comes back down, that one's going to slip even further. That's how we want to think about this. Not just say, oh my gosh, look at this big gap. Let's fill it. So let's take a look at what those might be. We'll take a look at our sectors. And today I'm going to look at it just purely on a 1 day intraday basis. So this is 6:30. Yes. So anything below here, this one, actually lost some money today. So this one was XBI. Oh, no. That one made money. No, this one, XBI. No, XBI lost money. Okay, so this one lost money. Anything below here, these all lost money. So XBI just a tiny bit. Let's look at the weakest ones. So this one is real estate. It lost the most today. Then XLP. So no surprise, we just saw these as weak sectors. Then we've got healthcare and we've got retail. So that's interesting. So we've got staples, real estate, retail, and healthcare. That's a pretty mixed bag. You would think that retail should be up here with all of these others. So we're getting some mixed signals in here where it's not a clear cut. So that also tells me that the road upwards is not a clear path. It's not a straight path. It's a bumpy path. It is a path full of perils. So we want to be careful. We want to enter judiciously only when there's a pullback. If we had all of the high risk sectors on top of all of the medium risk sectors on top of all the low risk sectors in this nice, neat stack, then we would say, hey, this is a normal bull market. But right now, it's just a gap up. It's not a bull market yet. If we get a pullback or a consolidation and then a move forward, then what should happen is this jumbled mess of sectors should align itself so that we do have a nice stack of high risk, medium risk, low risk. But until we get that, the path is not clear. We can still go up. It's just going to be a bumpy road to get there. When all of them are stacked nicely, then it's a nice smooth road. It becomes very easy. Basically, any stock that you pick will go up, right? You don't have to have any sort of skill. You just, buy this and it goes up. Right now, that's not the case. Right now, you do need stock picking skills in order to pick the ones that are actually going to go up. So we want to, but we're talking about a pullback, a potential pullback. So if we want to play that, then we would want to be in real estate, healthcare, retail, and staples. Okay, so let's take a look at that. XLRE, real estate. Okay, you can see that a nice big huge red bar today into an MA 150. That's not a super well followed moving average. It is followed, but just not nearly as much as the 50 or the 200. So this is a little bit of a phantom. Yeah, there's not a lot of liquidity here. So that's a little bit of a phantom level. So that could fall through very easily. I wouldn't count on that. I don't know why this purple line is here, but it is drawn at a nice liquidity level. So that would be, or maybe even slightly higher right there. That would be a good area potentially for it to move down to and then find some support. So real estate looking like it could continue its move downwards. Then we've got, and of course we are looking at a smaller time frame, right? We're looking from this past quarter, not the whole year. The whole year still looks like it's going up, but we're looking at from this quarter. So this would be a shorter term trade. It wouldn't be a year-long trade. It wouldn't be a several month-long trade. If I'm looking at just the past, what is this, roughly 60 or so days, then not even 60 days actually, probably about 45 or 50 days. If that's my time frame, then I'm only looking to hold on to a trade like this for a few days, maybe 3 to 5 days. So in the short term, yes, we are looking for continued downward movement in XLRE, and we only want short term anyways, because we're just counting on the S&P 500 potentially pulling back for a couple of days before it resumes its move upwards. So that's perfect. That's perfect for us. XLRE looks like it has potential. Let's look at XLV. Oops, XLV. XLV, big, huge red bar, but really, if we just look at the close, it's just been going sideways for a week or so now, getting bottoming out or finding some support near or around that MA200. MA200 is a significant level that a lot of institutions benchmark themselves, or not benchmark, but they use it as a guideline. So that's not a random level. That this has some significance here. So I probably wouldn't choose XLV just because it looks like it's going sideways more than it is moving downwards. So far, real estate is our best bet. XRT, retail went up. Maybe I looked at this one wrong. What is this one? That's healthcare. That's staples. That's retail. Down 1.62%. Oh, sorry, down 1.62% from the open, not from the previous day. So yeah, on the day where opened, no, it's up. One of these charts is wrong. Okay, so we're going to ignore retail. It's just chopping sideways. And, it was the weird anomaly anyways, because we had consumer discretionary up quite a bit. We had tech up quite a bit. Other high risk sectors up quite a bit. So it didn't really make a lot of sense that retail was down. And now that we're actually looking at the chart, it gapped up and it stayed up. Yes, it moved in a huge range up and down and kind of landed in the middle. But it's not general weakness. It is relative weakness, but not general weakness. So forget XRT. So far, XLRE is our only candidate. And last one, XLP. XLP is looking very similar to XLRE. We have this area of liquidity or support at this purple line over here. So we could continue to move downwards at least to this purple line. Just because it hits this line doesn't mean that it's going to stop there. It just means that there's probably going to be some sort of reaction there. Like it might bounce off of it, it might consolidate sideways, it's just probably going to do something. It's probably not going to just fall right through it. But in a quarter trend, yeah, it's down. It's definitely down. So 4 or 5 days, a week, 2 weeks, that would be an appropriate timeline for a trade downwards in XLP. So let's take a quick look and see if we could find anything. Let me look at XLP, XLRE. So the other thing, though, that we don't want to forget is that we have the FOMC announcing that rate cut tomorrow. That directly impacts interest rates. So we probably don't want to be in XLRE. So let's go and take a look in XLP. We want something that's going to be neutral to or insensitive to any change in rate cuts. Generally, XLP or interest rates in general, XLP is generally not very sensitive to interest rates. Healthcare is not sensitive to interest rates. So XLP is a good choice for us. And we can just take a look and see what in XLP is weak. Probably all of them or most of them, but we want to see which ones are the weakest. And let's go to go backwards or go to the bottom of the list. There we go. Estee Lauder. Ooh, that is very weak. Dollar General is weak, but it's just been consolidating. Although if this breaks down, that could be really good. Same with Dollar Tree. If it breaks down, that could be really good. Let's just take a look at those three for now, because those are the most extreme. So if I look at Dollar Tree and Dollar General, very similar. So you would only pick one of the two if you're going to go into a position, unless you split your allocation between the two. But Dollar Tree, if it breaks this low, which was basically today's low, then yeah, that would look like a very nice short. We do have earnings coming up on it though. Let's take a look at Dollar General. Dollar General, very similar. It is basically, if it moves downward tomorrow below the current low, then, and we have a bigger distance to those earnings, Dollar General is looking great. Actually, it's looking pretty good. I like Dollar General quite a bit. And let's take a look at that last one, Estee Lauder. Estee Lauder gapped down on earnings, and it stayed down. There was no bounce. It didn't try to recover, and it is breaking that low of the earnings announcement day. That low was 63.36, and we closed at 63.28. So it did break that low. Both Estee Lauder and Dollar General are looking like really good short opportunities at the moment, at least for a few days. Follow that momentum in the S&P 500 downwards. Estee Lauder had a down day today, even though the S&P 500 had a big day up, and Dollar General also had a down day, closing very near the lows. Both of them closing very near the lows. Both of these look like excellent choices for the next few days. Okay, so I think we did a pretty thorough analysis. We went wide, we went broad, we narrowed it down to different sectors. We narrowed it down to precise stocks that we might be interested in. The only thing that I didn't do is take a longer term view and say, like, are sellers in control or are buyers in control? Well, sellers are in control here. Sellers are in control here. Sellers are in control here. And they're clearly in control since earnings. So, or not, yeah, since earnings. So sellers are in control. Yeah, we've had some consolidation over here, which made it less attractive, but now we are breaking down outside of that consolidation range. So that's why Dollar General looks so interesting to me. And now Estee Lauder, same thing. Sellers in control for a very long time, all year, all the last 2 years, 3 years, actually. So sellers in control here, 2024, basically everywhere we look, sellers have been in control and they continue to be in control, and we are breaking below that low over here. So both of those look like they're excellent choices. Okay, that's going to be it for today. Hopefully you learned a lot on how to dissect this, or maybe it was just way too much, way too fast, in which case the recordings are available to you. You can play it back anytime you want to and just review the materials. Have a wonderful rest of your day, and I will see you tomorrow.